Hi there, and welcome to Jill's Quest for Riches. Now, this episode is the episode 3 in the series about SPACs. So, if you're new to SPACs, I really advise you to start with episode 1. If you already know something about SPACs, maybe smarter to already hop in at episode 2. This is the final episode, episode 3. And what are we going to look into in this episode? Well, we are going to look into the management incentives for the management of a SPAC, word around Wall Street around SPACs, and what are actually good reasons for companies to go for a SPAC. I'm ready. I guess you're ready too. Alright, let's start off with what I think is the most important chapter in this series of 3 videos about SPACs, and that is management incentives. Why is that? Well, there's 2 things that I want to point out to you. First of all, SPAC management, or the promoters, often get a 20% stake in the new company that they merge with or acquire. And they do so by putting only a fraction of the amount of the cost of those 20% of shares. So indirectly, directly actually, they are diluting your shares. Very important to know. Now, to be honest, it is comparable to what other intermediaries take in, for example, the IPO process. There, the investment banks also take more or less 20% for their role in the process. What is, however, very different is that SPAC sponsors have a limited time to find their deal. So usually when you invest in the IPO of a SPAC, the deal is that if the management doesn't find a suitable company to merge with within 2 years, they pay back your investment plus interest on that, 2 or 3%. Nothing gigantic, but still an interest on top of it. So basically, SPAC sponsors or SPAC management, they have more an interest of doing a deal more than doing the best deal for you. So very often they will tend to overpay because in the end they still get their 20% stake for a small fraction of the price. And they overpay with your money, with the money of the SPAC investors. So that's a very important incentive that you have to understand in how SPACs go about. Word on Wall Street is that the SPACs are already on the decline or will be on the decline again soon. So most popular SPAC periods is supposed to be behind us, which can make sense. Like SPACs become interesting when you want to go faster to the market. So the more people fear that the interesting and easy way to gather capital, that period is approaching its end, the more people will still go for going public through a SPAC to still be a little bit faster and still catch that juicy period of very easy capital. You should also know that there's very frequently lawsuits of blind check investors, so people who invested in the beginning, the $10 a share, and then don't like the deal. I can understand, you don't have any idea what you buy, but then could be that you're not happy with the outcome, and then very often there are lawsuits here. These lawsuits are usually about the stake or the price that's not good enough according to a number of the investors in the SPAC. Another important trend to be aware of is that there's a growing number of retail investors, basically you and me, who were not institutional investors, we're not professional investors, we're just doing it a bit on the side. And that makes it more and more difficult to get deals done. Why is that? Because retail investors like you and me, we don't vote, right? We don't go to general assemblies or to special assemblies to put out our vote. Most of us probably don't even know how and when that should happen, right? We're not even following that up. But the problem is that there's a bigger and bigger fraction of the shares being held by retail investors, which makes it more and more difficult to get a majority vote to get anything done. Specifically for SPACs, for example, if you're nearing the end of the 2-year period as a SPAC management and you have a deal but it's not done yet, you need like just 2-3 more months to get it completely fixed and dealt with, then you need a vote from all the SPAC investors and a majority to be able to extend this 2-year period to maybe 2.5 years, because you're asking for an exception. So you need a majority vote, or for some votes you even need 60 or 75%. Now, if already 40% of the voters don't even show up, Like retail investors don't know there's a vote, or don't follow that up, or think, yeah, I only have 2 votes, what is my vote going to change? Well, then you never ever get to that percentage, you never ever get to take those decisions, and that makes it more and more difficult to get those decisions through. Now, I've been doing a lot of bashing on SPACs. Basically, there's really a lot of stuff you need to be aware of before you even think about investing in these. But there's also some good reasons why companies go for SPACs. One of them is because the IPO process is very long and intensive, and you might want to focus your resources on growing your company instead of raising funds. You can be sure if a company goes through an IPO process, the CEO, the CFO, their number one activity for that lengthy period of time is not the company, but is that IPO process and everything that goes around it. So that's also a period in which you're not focusing anymore on growing, on tackling problems, on getting your company further. And that might be, especially in a very, very fast moving economy, that might be quite a big handicap. Whilst with the SPAC, you can shorten this period, so your top management can again focus on the core activities of the company. Another good reason as a company to go for a SPAC is because the IPO process is a lengthier process, and that length brings along more uncertainty. If we start this process now, will we still be able to get as much capital in, let's say, 6 months as we would today? That's what drives a lot of IPOs through SPACs these days, because people are fearful that maybe in 3 or 6 months the capital markets won't be that favorable anymore. So they still quickly want to benefit from the very favorable situation we're in today. So they go through the fast track, because the last thing you want is being invested in this for 3 or 6 months in going public, and then the deal is just not good anymore because the market changed, the economy changed, people don't want to put that much money anymore into companies. That's horrible, right? So you want to avoid that by shortening the period. All right, so that's it for today. Just to be very clear, I'm not a certified financial advisor or any kind of that. So make your own decisions. This is not financial advice. I'm just communicating what I know and what I found out about SPACs. If you liked the video, be sure to like, and if you want to see more of these videos, be sure to subscribe. See you in the next one. Bye.